Most people think lenders decide based on a credit score. They don't. They're not asking, is this person perfect? They're asking one question: how predictable is this borrower?
What is this large deposit?
That's it. When you understand that, the entire home buying process starts to make more sense because lending isn't about liking your numbers. It's about assessing the probability that your financial story continues the way it's been going. And once you understand how lenders think, you can position yourself differently. When a file goes to underwriting, they're not scanning for one magic number. They're evaluating patterns, income stability, employment consistency, credit behavior over time, saving patterns, debt management rhythm. They're trying to answer, is this person financially steady? Underwriters aren't looking for perfection, they're looking for predictability. That's why two people with the same credit score can get very different outcomes because the score is just a summary. The pattern is the real story, and lenders approve stories that feel consistent and sustainable. Example: two buyers both have a 680 credit score. Buyer A has steady employment, consistent deposits, and no recent financial changes. Buyer B has the same score, but recently changed jobs, opened two new accounts, and has irregular income deposits. Same score, different predictability. That's why focusing only on the number misses the bigger picture. Lenders aren't approving scores, they're approving stability. Most surprises in home buying happen because buyers focus on the wrong things. They obsess over the score, they check rates daily, they compare today's market to 2020. But what actually creates friction? Sudden financial changes, large, unexplained deposits, switching jobs at the wrong time, opening or closing accounts right before applying. None of these are bad decisions, but they affect predictability, and predictability is what lenders care about. When buyers understand this early, they avoid stress later. Whether you're ready today or planning months from now, the principle is the same. You don't have to wait to plan, and planning doesn't always mean waiting. If you're ready now, the real question isn't, can I qualify? It's, does my financial story look stable and consistent right now? That's what makes approval smoother. If you're 3 to 6 months out, your job is to protect predictability, keep income consistent, avoid sudden financial shifts, be intentional about new accounts or large purchases, and if you're 6 months or more away, that's leverage. You can strengthen patterns, build saving stability, reduce volatility. Different timelines, same principle. Stability creates confidence for you and for the lender reviewing your file. A good mortgage conversation shouldn't feel rushed. It shouldn't feel like someone trying to push you into an application. It should feel like clarity. You should walk away knowing where you stand, what actually matters, what to protect, and what timeline makes sense. That's preparation, and preparation changes the entire experience. Home ownership doesn't start with approval, it starts with understanding. Once you understand how lenders think, you stop guessing. And when you stop guessing, the process becomes strategic instead of stressful. If you want to look at your own financial story through that predictability lens before you apply, that's exactly what the Homeownership Roadmap Session is for. It's focused, it's strategic, and it's designed to give you clarity without pressure. The link is in the description. Clarity first, application second.